Steps in the risk management process. Identify loss exposures. Measure and analyze the loss exposures. Select the appropriate combination of techniques for treating the loss exposures. Risk control. Avoidance. Loss prevention. Loss prevention. Risk financing. Retention. Non-insurance transfer. Insurance. Implement and monitor the risk management program. Identify loss exposures. Property loss exposures. Liability loss exposures. Business income loss exposures. Human resources loss exposures. Crime loss exposures. Employee benefit loss exposures. Foreign loss exposures. Intangible property loss exposures. Failure to comply with government rules and regulations. Risk managers have several sources of information to identify loss exposures. Risk analysis questionnaires and checklists. Physical inspection. Flowcharts. Financial statements. Historical loss data. Industry trends and market changes can create new loss exposures. For example, exposure to acts of terrorism. 2. Measure and analyze loss exposures. Estimate for each type of loss exposure. Loss frequency. Probable number of losses that may occur during some time period. Loss severity. Probable size of the losses that may occur. Rank exposures by importance. Loss severity is more important than loss frequency. The maximum possible loss. The worst loss that could happen to the firm during its lifetime. The probable maximum loss. The worst loss that is likely to happen. Select the appropriate combination of techniques for treating the loss exposures. Risk control. Techniques that reduce the frequency and severity of losses. Methods of risk control include avoidance, loss prevention, loss reduction. Select the appropriate combination of techniques for treating the loss exposures. Avoidance. Certain loss exposure is never acquired or undertaken, or an existing loss exposure is abandoned. The chance of loss is reduced to zero. It is not always possible, or practical, to avoid all losses. Loss prevention. Measures that reduce the frequency of a particular loss. For example, installing safety features on hazardous products. Loss reduction. Measures that reduce the severity of a loss after it occurs. For example, installing an automatic sprinkler system. Select the appropriate combination of techniques for treating the loss exposures. Risk financing. Techniques that provide for the payment of losses after they occur. Retention. Non-insurance transfers. Commercial insurance. Select the appropriate combination of techniques for treating the loss exposures. Retention. The firm retains part or all of the losses that can result from a given loss. Retention is effectively used when no other method of treatment is available. The worst possible loss is not serious. Losses are highly predictable. The retention level is the dollar amount of losses that the firm will retain. Select the appropriate combination of techniques for treating the loss exposures. Risk manager has several methods for paying retained losses. Current net income losses are treated as current expenses. Unfunded reserve losses are deducted from a bookkeeping account. Funded reserve losses are deducted from a liquid fund. Credit line funds are borrowed to pay losses as they occur. Select the appropriate combination of techniques for treating the loss exposures. A captive insurer. Insurer owned by a parent firm for the purpose of insuring the parent firm's loss exposures. Single parent captive. Insurer owned by only one parent. Association or group captive. Insurer owned by several parents. Select the appropriate combination of techniques for treating the loss exposures. Reasons for forming a captive include: the parent firm may have difficulty obtaining insurance. To take advantage of a favorable regulatory environment. Costs may be lower than purchasing commercial insurance. A captive insurer has easier access to a reinsurer. A captive insurer can become a source of profit. Select the appropriate combination of techniques for treating the loss exposures. Premiums paid to a single parent, pure, captive are generally not income tax deductible. They may be tax deductible if the transaction is a bona fide insurance transaction. A brother-sister relationship exists. The captive insurer writes a substantial amount of unrelated business. The insureds are not the same as the shareholders of the captive. Premiums paid to a group captive are usually income tax deductible. Select the appropriate combination of techniques for treating the loss exposures. Self-insurance, or self-funding. Special form of planned retention by which part or all of a given loss exposure is retained by the firm. Risk Retention Group, RRG. A group captive that can write any type of liability coverage except employer's liability, workers' compensation, and personal lines. They are exempt from many state insurance laws. Select the appropriate combination of techniques for treating the loss exposures. Advantages. Save on loss costs. Save on expenses. Encourage loss prevention. Increase cash flow. Disadvantages. Possible higher losses. Possible higher expenses. Possible higher taxes. Select the appropriate combination of techniques for treating the loss exposures. Non-insurance transfer. Method other than insurance. A pure risk and its potential financial consequences are transferred to another party. Contracts. Leases. Hold harmless agreements. Select the appropriate combination of techniques for treating the loss exposures. Advantages. Can transfer some losses that are not insurable. Less expensive. Can transfer loss to someone who is in a better position to control losses. Disadvantages. Contract language may be ambiguous, so transfer may fail. If the other party fails to pay, firm is still responsible for the loss. Insurers may not give credit for transfers. Select the appropriate combination of techniques for treating the loss exposures. Insurance. Appropriate for low probability, high-severity loss exposures. The risk manager selects the coverages needed, and policy provisions. A deductible. Specified amount subtracted from the loss payment otherwise payable to the insured. In an excess insurance policy, the insurer pays only if the actual loss exceeds the amount a firm has decided to retain. The risk manager selects the insurer, or insurers, to provide the coverages. Select the appropriate combination of techniques for treating the loss exposures. The risk manager negotiates the terms of the insurance contract. A manuscript policy is a policy specially tailored for the firm. The parties must agree on the contract provisions, endorsements, forms, and premiums. Information concerning insurance coverages must be disseminated to others in the firm. The risk manager must periodically review the insurance program. Select the appropriate combination of techniques for treating the loss exposures. Disadvantages. Premiums may be costly. Negotiation of contracts takes time and effort. The risk manager may become lax in exercising loss control. Advantages. Firm is indemnified for losses. Uncertainty is reduced. Insurers can provide valuable risk management services. Premiums are income tax deductible. Select the appropriate combination of techniques for treating the loss exposures. Risk management matrix. Select the appropriate combination of techniques for treating the loss exposures. Market conditions and the selection of risk management techniques. Risk managers may have to modify their choice of techniques depending on market conditions in the insurance markets. The insurance market experiences an underwriting cycle. In a hard market, profitability is declining, underwriting standards are tightened, premiums increase, and insurance is hard to obtain. In a soft market, profitability is improving, standards are loosened, premiums decline, and insurance become easier to obtain. Implement and monitor the risk management program. Implementation of a risk management program begins with a risk management policy statement that outlines the firm's objectives and policies, educates top-level executives, gives the risk manager greater authority, provides standards for judging the risk manager's performance. A risk management manual may be used to describe the risk management program, train new employees, implement and monitor the risk management program. A successful risk management program requires active cooperation from other departments in the firm. To determine whether the objectives are being attained, the risk management program should be periodically reviewed and evaluated. The risk manager should compare the costs and benefits of all risk management activities.